Hello, welcome on board AFM Advanced Financial Management. I'm Rashaad Hussain, your expert tutor for AFM. This is a debrief of question 2 Redwood Company from the AFM mock examination. I'm your expert tutor for AFM. For more than a decade, I've been on a mission to guide and help students nail FM and AFM exam. I'm also wearing the CFO hat at FinScript Limited. We are about to embark on a journey through a mock debrief for the Redwood Company. This is a 25 mark question, including 5 professional marks. Pay close attention to those professional marks. They are your secret sauce that can significantly boost your overall score. This question too is on an exciting topic. It's none other than APV, the adjusted present value. It also covers the topic of source of finance to specify Islamic finance and also the 5 professional marks. Now, I know it might sound a bit challenging, but trust me, it's going to be worth it. This relates to the study hub chapters of the first one, which is chapter 6, advanced investment appraisal, and the next one, which is chapter 16, the economic environment for multinationals. If you haven't attempted this question before watching this video, you're highly recommended to pause the video and attempt it, then get back to compare your answers. So now buckle up, get ready, because this mock debrief is your ticket to mastering the essential concepts and techniques needed to tackle this similar question like a pro. Let's jump in. First, let's look into the essential concepts to be an APV pro. Now, let's try to understand the difference between an NPV, a net present value, and the adjusted present value. So, as far as net present value is concerned, here the cash flows are discounted at what? At WAC in order to find out the NPV. If that NPV is positive, we shall accept the project. If that NPV is negative, we shall reject the project. Whereas, as far as APV is concerned, the adjusted present value is concerned, it has got two parts. One, the normal cash flows, and the other one, the financing effect. Here, the normal cash flows are discounted with something not with WAC. It is discounted with something called KEI, cost of ungeared equity. What is this cost of ungeared equity? So KEI is equal to RF plus, how do we find KEI? K is equal to RF plus beta, not the normal beta, not beta equity. It is going to be beta asset into RM minus RFY. Beta asset is assumed to only reflect the business risk. It does not reflect financial risk. So we are only looking into the business risk element, and the financing side effects are considered separately. Now, how do we find out this beta set? The beta set is equal to beta equity into value of equity divided by value of equity plus value of debt into 1 minus tax. So using this beta asset into the CAPM formula, we get this thing called ungeared cost of equity. Using ungeared cost of equity, the cash flows are discounted to find out something new that is called as the base case NPV. This base case NPV can either be positive or negative. Under the financing side effects, as far as interest is concerned, we are first going to find out what is it, the tax saving on interest. This tax savings on interest is to be discounted. The interest is, yeah, the debt is assumed to be risk free. It is supposed to be discounted at risk free, or KD, the cost of debt. And what we get from here is called as the present value of tax savings or tax shield on interest, which is again going to be positive. The second part of financing is that we might have certain debt which is at subsidized rate, which is the we've got the subsidized loan, and on that subsidized loan we tend to save interest. So the interest that is saved less on the interest that we have saved, what we lose the tax relief or we lose the tax shield. So tax relief lost is supposed to be discounted at a gain. It's considered to be risk free. That is considered to be risk free, either RF or KD. We find out what is called as present value of after tax interest subsidy benefit. Interest subsidy benefit, which is again going to be positive. And the last part of the financing is the issue cost, which, since it happens in year zero, it's not going to be discounted, but we convert it into post tax, we adjust it for tax. So we're going to have post tax issue cost, and issue cost is always negative. And once we consider all these four cash flows, all these four present values, we get something called as APV. If this APV is positive, we are going to accept the project. If it is negative, we are going to reject this project. So, using this basic concept, now let's head into this Redwood company. Let's try solving this question and let's be a APV pro. And let's now move into the exhibits, requirements, and solving it. Our interesting APV question, the Redwood company has got three exhibits, the requirement and response option. We have got two response option, the word processor, the spreadsheet. Now the exhibits are Redwood company, project cash flows, other financial information. Let's start with the exhibit. No, that's a wrong approach. That is not how you are supposed to start approaching a question. You are supposed to first read the requirements, go through the requirements. Once you have gone through the requirements, and then start off with the exhibits. So let's jump into the requirements. Opening the requirements. Even before we read the requirements, let's have the requirements in the word processing. Let's copy all the requirements and paste it into the word processor, and let's organize it. We've got requirement A, which is for 5 marks. We've got requirement A is for 10 marks. We've got requirement B, which is for 5 marks. We've got requirement C, which is again for 5 marks, and then we have got the professional marks. Requirement A is about to estimate the adjusted present value of the proposed investment. And requirement B is about explaining the difference between APV and NPV as methods of investment appraisal and comment upon the circumstances under which APV might be a better method of evaluating a capital investment. And requirement number third requirement, the C requirement, explain the major difference between Islamic finance and other conventional form of finance, such as those being considered by Redwood. Identify and briefly discuss two Islamic financial instrument that could be of use to Redwood company in the above circumstances. So this year requirement worth 10 mark, and since being more of a computational part, it is recommended to have that done in the spreadsheet. So copying and inserting that requirement into the spreadsheet. Now let's move through the exhibits to pick the information. Going to the exhibit 1, the Redwood company. As we go through the exhibits, let's start picking up the point for the solution as well. Now, Redwood Company is a company known for its success in the paper manufacturing industry. They are planning for a transformative change. The managers of Redwood are investigating a potential 25 million funding. So what is the total fund required? The total fund that is required is 25 million. Adjusting the columns. Now let's read further. This venture represents a diversification away from their familiar mainstream activities into the printing industry. To make this vision a reality, they intend to allocate 6 million from their internal funds. So of these, we can see that the internal funds, how much is the internal funds? Is going to be 6 million. Okay. Further reading, a rights issue 6 million from their internal funds, generate 10 million through rights issue. The second one, which is the rights issue, through rights issue, we intend to raise 10 million and secure an additional 9 percentage million through long term loans. So we've got long term loans. How much is it? 9 million. Okay. This strategic move signifies Redwood Company's commitment for a dynamic future, one whereby they blend their established expertise with evolving world of printing. Now, moving into the second exhibit for further information, the investment is expected to generate earnings before depreciation and taxes. So, down we let me note a few points. What is it? Earnings before depreciation taxes, and that is amounting to 5 million per year for a period of 10 years. This is for 10 years. The residual value at the end of year 5. Okay, further when we calculate the base case NPV, we will require year 0 and year 1 to how many years? 10 years, 1 to 10 years, and 10th year, the residual value, which is 5 million, which is after taxes. Uh, what makes this investment even more compelling is its alignment with the government's development goals in a move to foster growth in the sector. A favorable opportunity presents itself with a subsidized 4 million out of the 9 million. Okay, of this loan, what we have here, we are also provided with a subsidized loan, and the subsidized loan is of how much? It's of 4 million. So out of the 9, if this is 4 million, this turns out to be how much? This turns out to be 9. Sorry, out of 9, if I reduce 4, I get 5 million. I get how much? 5 million. Okay. This specialized loan comes at an attractive interest rate of 2% below the company's normal cost of long-term debt finance, which is typically 8%. So the long-term loan is going to be at 8%, but the subsidized loan is going to be 2% cheaper, which is going to be 6%. This subsidy not only enhances the feasibility of the investment, but also underscores the government's commitment to nurturing and bolstering the industry. The next exhibit, other financial information. Redwood Company's financial profile is a critical component of their investment evaluation. Their equity beta stands at 0.85. We cannot take their existing beta equities to start off. We are going into an unrelated industry. In terms of financial structure, they maintain a balance of 60% equity and 40% based on debt based on market value. Comparatively, when assessing the broader printing industry, the industry norm represents an average equity beta of 1.2. So we can somewhere note down here below, what is it? Beta equity of printing industry is 1.2. The industry tends to have an even split between, and yeah, we'll add that as well, and debt equity of 50 is to 50. To calculate the cost of capital, the risk-free rate currently is, and we can also note down that the risk-free rate uh, is 5.5 percentage and market return is 12 percentage. Furthermore, it is important to note that these funds raised for this investment are net of issue costs. These issue costs are estimated to be. So here, what are the issue costs? This is the amount that we've raised, and the next one is issue cost, and issue cost on the rights is estimated to be on 1 percentage for the debt, 1 percentage for the debt, and 4 percentage for equity, and 4 percentage for equity. These expenses are non-deductible for tax purpose. The corporate tax is at the rate of 30%. Now, I've got all the information. I can start working on it. The amount of issue cost, the amount of issue cost would be divided by 96 into 4, and here divided by 99 into 1. That's going to give me the gross amount. Expand the cell. So we've got the gross amount, and this can be very well, very neatly put across as working note 1, which is funding and issue cost. Now, working number 2 would be calculation of tax savings on depreciation. And here it is going to be year 1 to 10 years, it's straight line method. The opening balance of the asset is 25 million. The closing book value is not considered. Why it is not considered? Because it's very clearly stated that what is it? It is after tax. So going to take it as zero. It's subject to tax, and then we've got the depreciation, which is as per the SLM method, and which is going to be just divided by 10. Now we've got the depreciation working note. And the next one will be for calculation of what is it, the cash flows. For calculation of base case NPV from the information, we need to get what is it, calculation of cash flows and particulars amount. The EBT, we've got EBT, which we have already noted down. And to this, the depreciation, let's minus the depreciation, which is going to give me EBT, and here plus this, and then tax at the rate of 30 percentage, 30 percentage, which is going to give me EAT, earnings after tax, and adding back depreciation would give me cash flow after tax. Now, with all these information, we'll be able to go into the next working note number 4, which is calculation of base case NPV. Base case NPV. Now here we need to find the beta asset of printing industry. We need to find that out, beta asset of printing industry. We already have beta equity, which we have noted down. Finding beta asset. We will finding beta asset of printing industry. And that's supposed to be equal to beta equity into value of equity divided by value of equity plus value of debt into 1 minus t. And that is 1.2 into 50 divided by 50 plus 50 into 1 minus 0.30, which would give us 0.705 and rounding it off to 0.71. Using this in order to find out the ungeared cost of equity, finding ungeared CAPM, and how do we find that out? The risk-free rate is given as 5.5 plus 5.1 plus 0.71 into 12 minus 5.5 will give me 10.11, that is approx, or rounded to 10 percentage, rounded to 10 percentage. Now using this we can find out with the base case NPV. Here cash flow, the cash flow is 25 million, and 25 million. Okay, and the cash flows, the after tax cash flows over here, the discount factor at the rate of 10 percentage, 1 is 6.145, and here 0.386. We can find out the annuity factor 6.145 using the annuity factor shortcut. This one into this. Copy, paste, navigating way back. Copy, paste. Expanding the column in order to accommodate all those numbers. This is going to give me equal to sum. Sum of all of these is giving me the base case NPV. What is this called? This is called as base case NPV. Now we have found out base case NPV. Now furthermore details is required as far as the financing side affects, present value of tax relief on interest, as well as the present value of after tax interest subsidy. Now moving on to that for the working note number 5, which is financing side effects. Will give present value of tax relief on interest. We've got the loan, we've got loan, subsidized loan, and the amount to give reference on the top, and what is the rate on this? The rate on this is 8 percentage and 6 percentage, and that's going to give me the interest. How much is interest on this interest? And further, the tax relief on interest is going to be into the interest into tax percentage. On that, discount factor at the rate of 5.5 percentage would give me 7.538, and then present value of tax relief on interest. And next, This working note, which is working note number 5, financing side effects of present value of tax relief is done. Now the last working note, which is working note number 6, which is financing side effects. What is it? What are we finding? Present value of tax after tax subsidy benefit. Again, here this is the subsidized loan. The subsidized loan, its amount. What is the interest that was saved? The interest that was saved is 8 minus 6, which is 2 percentage. What is the interest saved amount? This into this much interest is saved. What is the tax shield shield lost? Tax shield lost is this into 30 percentage we have lost. And what is the after tax benefit? The after tax benefit is this minus this, the after tax benefit. On the after tax benefit, discount factor at the rate of 5.5 percentage and 7.538 give us present value of after tax subsidy benefit. Yes. Now all working notes are over. With these working notes, I should be able to calculate the I should be able to do the calculation of APV. I can have a particulars particulars amount or maybe a working note for reference. Working note for reference. The B column just expanding it a little bit more, and what all do we base case NPV, base case NPV, which is from working note number base case NPV is working note number 4 give equal to, go pick it up, base case NPV picked it up. Next one, the issue cost of rights, issue cost, rights issue cost working note number 1, and then we have got loan issue cost, again working note number 1. To give reference, let's go pick that issue cost, pick the issue cost, and then we've got present value of tax shield. Two things, one is the loan, this is for working note number 5, and also the subsidized loan is again working note number 5, going selecting those amounts. And the last one, which is present value of subsidy benefit, working note 6. All of these together is supposed to give me the adjusted present value equal to sum. The issue cost is supposed to be taken as negative. Its sign has to be rectified. And here go insert a negative. Next one also negative. And this gives me the adjusted present value. The adjusted present value, the most important thing, the APV is positive. Positive APV projects shall be recommended. Now, the same thing, just repeating it through a presentation so that if you have any clarity required, you can pick it through the presentation. The same thing, now going through the presentation. Now, moving into the solution, the first thing is about calculating the issue cost. And how much is the total funding that we require? We require 25 million. What is the split of this 25 million? The first internal funds, 6 million. No, it has got no issue cost. And then we have got the rights issue, which is 10 million. There's a 4% issue cost. We need 10 million net of the issue cost. So how do we calculate the issue cost amount? That's going to be 10 million divided by 96 into 4 is going to be a issue cost. What's going to be the gross amount? That's going to be 10 million divided by 96 into 100. Well, the next funding is loan, which is 5 million. Again, it has got 1% issue cost. That's going to be 5 million divided by 99 into 1. And here it is going to be 5 million divided by 99 into 100. So we have, and the last thing is the subsidized loan. We have got all the gross amounts as well as the issue cost. Now, this is our first working note. And the second thing, we are going into the calculation. We need to find out the base case NPV for which we need to find out the depreciation. The asset is purchased for 25 million. Yes, there is a disposal value, but we don't reduce the disposal value in order to find out the depreciation because it's specified in the question that that disposal value of 5 million is subject to tax and it is after tax. So the opening balance 1 to 10 years using straight line method, 1 to 10 years, the opening balance is 25 million. There is no closing balance. Why? It is after taxes and the depreciation is 2.5 million every year. So 25 million divided by 10 is going to give me 2.5 million. Now, we need to get the cash flows. How's the cash flows? We the earnings before depreciation tax 5 million is there. We reduce depreciation, which we got it from the second working note. We get EBT. We are supposed to reduce tax at the rate of 30%, which is 750,000 reduced from 2.5 million gives me EAT earnings after tax, which is 1,750,000. I need to add back depreciation and adding back depreciation gives me cash flow after tax of 4,250,000. Now, year zero, the investment is 25 million negative. 1 to 10 years, it is 4,250,000 or 4.25 million, and the 10th year, there is 5 million, which is after taxes. Now, what is supposed to be my discount factor? My discount factor is supposed to be KEI, cost of equity, ungeared cost of equity. How do I calculate it? That is equal to RF plus beta what? What? Not beta equity. Beta asset into RM minus RF. Now, how do I get this beta asset? Beta asset is equal to beta equity into value of equity divided by value of equity plus value of debt into 1 minus tax. Which beta equity? The beta equity of the printing industry average. I'll take that beta equity, which is 1.2, and the value of equity is 50, value of debt is also 50. Using that, I'll find out the new beta asset, the beta asset of the printing industry, which is assumed to be same within the industry. Based on the Modigliani's Miller's assumption, where we assume debt to be risk-free, beta debt is taken as zero. We find out KEI. This KEI is used as a discount factor in order to find the NPV, and this NPV, the new NPV, is called as the base case NPV. So let's find out the beta asset first and then find out the cost of equity ungeared, the beta asset, assuming the risk of the companies in the printing industry is similar to that of the Redwood's new investment. Here it is assumed that in the entire printing industry, the beta asset remains same. So continuing, the beta asset of the printing industry will be used to estimate the discount rate for the base case NPV. Further, assuming that debt used in the printing industry is typically risk-free, that is beta debt is zero, then we can ungear the equity beta of the printing industry as follows. Finding out the beta asset is what is it 0.706. Substituting the values using that in the CAPM, to get the ungeared cost of equity. The ungeared cost of equity comes to 10.09. We are rounding it off and taking as 10% to be discounting the cash flows that follows. Now, from the annuity factor table of 10%, 0 year, 2.5 million negative outflows, 1 to 10 years. From working note number 3, we got 4,250,000. And in the 10th year, 5 million uh, discounted gives us a base case NPV of 3,046,250. Now we have got the base case NPV. We've got issue cost. Now we need to find present value of tax reliefs. Next working note, the financing side effect about the present value of tax relief on interest, the loan, the gross amount on which 8%, when I multiply 8%, I get 4 lakh 4,040. On that, tax relief is at the rate of 30%. Tax relief is at the rate of 30%. This 30% is supposed to be discounted at 5.5% for how many years? 1 to 10 years. When I multiply it with that annuity factor of 5.5% for 10 years, it gives me, what is it, 9 lakh 13,697, or otherwise 913,697. Next, we have got the loan, the subsidized loan, around 4 million. When I take 6%, it gives me 2,40,000. Taking 30% tax relief on it, again the annuity factor of 5% for 10 years gives me 542,736, which is my present value of tax relief on the subsidized loan. Now, the subsidized loan, instead of the 8, I'm paying only 6, I'm saving 2%. I need to find the benefit of that 2%. So, the next working note is to calculate the benefit of that 2% on the subsidized loan. Present value of after tax subsidy benefit on that 4 million, 2% gives me 80,000. But when I save that 80,000, I'm actually losing my taxes, my tax savings. So 30% of it, the tax savings I lose. When I minus that, I get a net benefit of 56,000. Again, multiplying it by 5.5% annuity factor for 10 years gives me a benefit of 422,128. 422,128. Now, taking all these information that we have collected in order to calculate the APV, the base case APV from working note number 4, the issue cost from working note number 1 of the rights and the loan, and the present value of tax shield of the loan and the subsidized loan from working note number 5, and finally the present value of subsidy benefit from working note number 6 gives me an APV. There's a positive APV of, what is it, 4,457,639. Now, the APV is positive. The diversification of Redwood into the printing industry shall be recommended. Is this sufficient? Absolutely not. This will not help you score professional mark. Yes, we need to go in more. How do we score that? What is the secret in scoring the professional mark? What is the trick? Yes, let me give you a wonderful checklist, a secret checklist that help you score this professional marks. So let's have a look into that checklist. For communication, what are the things that we need to check? Whether there is headings, subheadings, whether very brief introduction or explaining content that follows. Is there an appropriate language, clear and concise language? Is the structure calculation into appendixes done? Evaluation. Have we used the appropriate data? Is there any possibility of further analysis possible? Can we mention any lack of data? Have we given a balanced appraisal leading to justified conclusion? Skepticism. Is there a questioning approach? Have we challenged the information of the question and the evidence provided? Have we stated problems with the assumptions? Professional judgment to draw a conclusion? Commercial acumen. What does work and what doesn't work in the real life scenario? Have we mentioned that? Practical considerations. Can we write something on that? Internal, external environment and constraints. Finally, possible consequence of the past and the future actions. What are certain very easy things that we can probably highlight now, extra highlight in the conclusion that we have done? We can speak about further analysis. We can go for, instead of just saying we should accept, we can say when we accept, we need to take care of certain things. We can challenge the information. We can speak about the assumptions. So some of the very easy things that we can score in order to get a little more professional marks. So let us add these couple of things to the conclusion. Now, adding that to the conclusion, let's see how our answer would look like. Based on the estimate provided in the question, the project is financially viable. But, what else can we bring in? Why don't we just ensure that the figures given, uh, whether there is, very small change of it will not make the the NPV negative. Let us assess all the variables. How is that possible? That is possible through sensitivity analysis. We can write about sensitivity analysis. Sensitivity analysis should be undertaken on all significant variables. We can ask them to do a little more further study, further analysis. We can, maybe challenge the assumptions, particularly assumptions which lie behind cash flow, such as EBT and the tax rate. This is one of the easiest way to fetch a little more marks and getting better scores. Now let's look into the next requirement, the requirement B. Now into the second requirement, the B requirement, explain the difference between APV and NPV as method of investment appraisal, and comment upon the circumstances under which APV might be a better method of evaluating a capital investment than NPV. This is worth 5 marks. So, how do we write first about the difference? Now, what is the difference? See, basically, both APV and NPV are discounted cash flow techniques. But what differs in them? Difference is only the way how they incorporate the project finance. What happens in NPV? In NPV, the discount factor that we use is WAC is used as discount factor. We find out the thing called NPV. If that NPV is positive, positive we shall accept, otherwise we shall reject. But APV has got two stages. One where the project cash flows are discounted not using WAC but rather ungeared cost of equity, and we find something called base case NPV. And then the financing side effects are, what is it, the present value, it's discounted at mostly, what is it, the risk free rate or maybe KD. So it's done across two stages. What are those two stages? Project cash flows are discounted at ungeared cost of equity to find out base case NPV. The financing side effects are discounted at risk free rate or KD. Now, when do we find what is the second? Comment upon circumstances under which APV might be better. When do you think APV might be better? APV is better when there is huge change in the capital, or maybe the capital is heavily funded by debt. So there is significant change in capital, one thing. Second thing, there is very complex tax payment or tax allowances, or maybe there are subsidized loans, maybe there are grants, maybe there are issue costs that we need to consider. And finally, what is it, the financing side effects? When we are discounting it with a different discount rate, it's highly recommended to follow the APV method. Now let's see how these things that I've explained, how do we put it across. Let's move and see how the answer is put across, how the B is presented. Now, B requirement, drafting the points that we have just discussed. Both APV and NPV are discounted cash flow techniques, but differ in the way project finance is incorporated into the process. With NPV, the discount rate, which is applied to the project only cash flows. WAC is used to discount the project cash flows. APV involves two-stage process dealing with the project and financing flows separately. Project cash flows are discounted at an ungeared cost of equity to calculate base case NPV. Financing side effects are then discounted at an appropriate, usually pre-tax risk-free rate. Now, when is it more appropriate? APV may be a better technique to use than NPV when there is a significant change in capital structure as a result of the investment. The investment involves complex tax payment and tax allowance, or has period when tax is not paid, subsidized loan, grants, or issue cost exist. Finally, what is it? The financing side effect exists. Example, the subsidized loan, which require discounting at a different rate than that applied to the mainstream project. Now, this is how the requirement B is supposed to be presented. Now let's move into the next one. The third and the final requirement, the requirement C, explain the major difference between Islamic finance and other conventional form of finance, such as those being considered by Redwood Company, identify and briefly discuss two Islamic financial instruments that could be of use to Redwood Company in the above situation. For how many marks? 5 marks. So what is the first thing over here? The major difference between Islamic and other conventional form of finance. Now, Islamic finance is based on the principle that money should not be making money. Money making money, interest is forbidden, it is prohibited. And any reward you get, you're also supposed to share the risk. Whatever wealth is generated is supposed to be generated out of trade and asset based investments. We are supposed to avoid harmful activities such as gambling, alcohol, and finally, what we do is not just for the purpose of pure return, but it is supposed to be about a wider perspective, a wider ethical benefit to the society as such a whole. Now, the conventional form of finance is all based on interest, which is supposed to be prohibited, which is prohibited as per Islamic law. Islamic law is based on this law called Sharia law. And the Sharia law states it should be not just based on sharing the rewards, but also share the principle of sharing the risk as well. The two alternatives that could be proposed here, one we could probably propose the murabbaha, which is a form of trade credit where the finance provider he buys an item and he sells it at a markup, at an agreed markup. This agreed markup is not supposed to be increased, and this can be paid in installments. The next one that could be proposed is the sukuk. The sukuk holders have proprietary interest in the asset, and how is their income? Their income is the share of income generated by these assets. The major difference between this sukuk and murabba that we have discussed is that sukuk holders they have only ownership to the cash flows and they don't have ownership of the assets. Now let's draft this into the answer. Now, articulating what we have just discussed, Islamic finance. Islamic finance rests on the application of Islamic or Sharia law. The main principle of Islamic finance are that the use of money making money is forbidden. Risk should be shared. Wealth must be generated from legitimate trade and asset based investment. Harmful activities such as gambling, alcohol, and sale of certain food should be avoided. Investment should also have a social and an ethical benefit to the wider society beyond pure return. The, raise, the raising of term loan debt finance as proposed by Redwood would violate the principle of sharing risk and of not using money for the purpose of making money. Under the Islamic law, the charging and receiving of interest, that is riba, is strictly for prohibited. This is in sharp contrast to the more conventional Western form of finance. One alternative form of finance would be murabbaha, a form of trade credit for asset acquisition. Here, the provider of finance would buy the item and then sell it on to Redwood at a price that includes an agreed markup for profit. This markup is fixed in advance and cannot be increased, and the payment is made by installments. Another form of finance would be Islamic bonds known as sukuk. To be Sharia compliant, the sukuk holders must have a proprietary interest in the asset which are being financed. Sukuk holders' return for providing finance is a share of income generated by the asset. The key distinction between sukuk and murabbaha is that sukuk holders have ownership of the cash flows, but not the asset themselves. And that's the third requirement. And well, that's all for now. Wishing you all the best for your upcoming exam. This is your AFM expert tutor, Rashaad Hussain, signing off. Thank you.